Welcome back to America's Commercial Real Estate Show. I'm Michael Ball. This segment's brought to you by RedIQ. Check them out. They turn data into actionable intelligence. Their website is rediq.com. Today, we're talking with George Ratiu, and he's with the National Association of REALTORS, and they put together an annual report with Situs RERC, with, of course, the National Association of REALTORs, and Deloitte, and it's a very good report. We'll put a link below to the actual report, and we're talking with George on Skype about some of the highlights. And George, multifamily, everybody knows, has had an incredible run, but we've also seen a lot of new development, especially in some of the major cities. It's just, we're here headquartered in Atlanta, and the number of apartment communities going up just seems crazy, but they seem to be filling up. I don't know how these tenants are affording it or where they're coming from. So what do you guys look like? What's the outlook for multifamily moving forward?
So multifamily, to your point, has performed very well during this cycle, and that really, in large part, thanks to continued population growth. So the U.S. has grown about 8% in the last decade in terms of population. And in terms of household formation, or a main measure of demand for housing, while that took a beating during the recession and post-recession environment, it's been moving towards its long-term average. Historically, we've had about 1.3 million new households formed every year, and this past year we basically were at roughly 1 million by September. So we're likely going to be a little bit above that number. So we're moving towards historical averages. With that, obviously, demand for housing has been solid due to strong employment growth, wage growth. The one thing we have had a challenge with during this cycle specifically has been supply. When you look at the residential housing, there's a lot of shortage of available housing. That, coupled with rising mortgage rates, rising prices, quite on a steep trajectory, have basically offered for a lot of folks the rental market as the main viable alternative. And to your point, developers have obviously paid attention to these trends and have been bringing a lot of product to market. The interesting thing, I think, about the market is a lot of the product coming online has been Class A. So to your point, not a particularly affordable option. But I think for a lot of folks, the living downtown, particularly in the downtown core, has been quite attractive as we see major demographic changes take place. So our expectation for 2019 is that this demand will continue to shape the market. And while we've had obviously strong supply, in fact, in 2018, supply outpaced demand slightly, we expect that to remain the norm in this year. Likely the cash flow, so rent increases, will moderate. We've seen a slowdown in rent increases from about 5%, 6-7 years ago, to about 2%, depending on the market, a little less than 2%. But I think that the sector's attractiveness remains, and for a lot of investors, I think they're beginning to see and recognize attractiveness in Class B, in value-add projects, to address particularly that shortage of workforce housing.
Yeah, and you mentioned that the housing market, the single-family home market, impacts multifamily, and obviously it impacts the entire economy, and therefore all the commercial real estate. And hey, we've got George here from the National Association of REALTORS, so I have to ask you, what do you expect for the housing market moving forward?
Well, we've seen housing market undergo a slight shift in 2018, more specifically due to the shortage of available supply. A lot of folks have basically run into a wall. They'd like to purchase, but they have very little product. So sales actually declined in 2018. Prices, due to this shortage and continued demand, actually ticked up. So we expect 2019 to practically be level, maybe a slight decline in sales, but we expect prices to continue on a moderate upward trend, in large part because whenever we survey our members as well as consumers, what they're telling us is that folks still want to buy a home. So it's obvious that demand continues to be there. The big question right now is will we collectively be able to address the shortage by providing a stronger supply, particularly because even in residential, not unlike commercial, a lot of the new home construction has been targeted towards the upper end, so the luxury market. And so we're running out of steam there. What we need a lot more of is workforce housing for obviously a lot of the middle class consumers for whom choices right now on the market are few and far between.
Yeah, and that's obviously difficult with rising construction costs and rising land cost and more regulations from the municipalities and the government. It seems to be an ongoing challenge, doesn't it?
Yes, indeed. In fact, when we try to identify, to your point, that we have obviously higher construction costs, there's been in fact a shortage of construction workers for a lot of builders. But the one aspect that's been very impactful in terms of cost have been zoning regulations, and obviously they vary across municipalities across the country. But from environmental fees to all kinds of other fees, they have indeed raised the cost of building, of developing housing, and in turn obviously makes it hard for a lot of developers to justify being able to offer something in an affordable price range. So I think until we have a much closer look at how cities are approaching their zoning, this conundrum will continue.
Yeah. Well, let's talk about the hotel market, the hospitality market, because that sector can change a little faster, right? They're daily rental agreements. So what do you guys expect moving forward there?
So this particular cycle, the hotel sector was obviously impacted early on due to the recession. A lot of companies cut back, a lot of consumers obviously cut back. But during the last few years, the hotel sector has done quite well. In fact, we've seen business travel pick up. Moreover, and just as importantly, we've seen consumer spending on leisure, recreation, actually be quite strong over the last couple of years, which has resulted in obviously strong demand for hotels. Conversely, the pipeline in terms of supply has also picked up. And in 2018, that supply rose at about 1.9%, a little slower than the prior year, 2%, but it was still strong. So what we've seen hotel operators obviously have to contend with revenue per available room moderating. And looking forward to 2019, the big thing is we expect occupancy to actually notch up a little bit, which is positive. But because the increase is moderate for hotel operators, it means they'll have to maintain their expenses, their operating expenses, below 3% in order to squeeze profits out of it. So to your point, this is one sector which tends to see impact from any change in economy and consumption much faster than the other property types. So it's still a good environment for hotel operators, but one in which capital discipline and operating margins are very important.
Yeah, well, good point. We just put on the market 9 different hotels, and there's a lot of demand for them, and some of these families have owned them a long time, and they look at the economy and say, hey, maybe this is the time to sell them because there is a lot of demand right now and people feel comfortable with it. Well, George, what would you leave our audience with related to this report? Obviously, when you look at you and all the other stars that were involved in putting this together, there's a lot of experience there. What's the ending theme here that you'd leave our audience with?
I would say that in as much as we truly find ourselves in uncharted territory, to echo the theme, I think that on balance, when simply we take the fundamentals, both economic as well as real estate fundamentals, most of the drivers point to continued expansion in 2019. And just as importantly, for commercial real estate, we see continued demand in terms of fundamentals. We see cash flow remain positive. I think that for a lot of listeners and viewers, the one thing to keep in mind is that obviously the downside risks have accumulated, everything from obviously the interest rate risk that's still there, despite the fact that the Fed is a lot more patient and cautious, to geopolitical risk. There are quite a few. We still have, obviously, trade disputes, trade tensions boiling over. We have political unrest in quite a good portion of the world. So any one of those could lead, obviously, to a slowdown in economy. But from the broader perspective, we see commercial real estate market still well positioned, and for a lot of investors, we see the returns from commercial real estate remain attractive into the near term.
Well, great. Well, I feel good now, George. Thank you for that, and thanks for being on the show. Great information as usual.
Certainly, Michael. It's always a joy chatting with you. Thank you.
All right, and let us know what you think. We appreciate you sharing the show and commenting and reaching out to us through any of our social media sites. You can find them all at commercialrealestateshow.com. And until next week, please join us next week. And until then, be sure you always lead, learn, and laugh, and join us for America's Commercial Real Estate Show.